All right, welcome back, guys. We are in week 6 of It's Your Estate. Today's topic, retirement account planning, is it's a very interesting conversation we're going to have with our attorney today, Michael Simon, who is an expert in this particular area. And there's been a lot of new legislation that kind of affects a lot of the topics we're talking today. So this is a very pertinent conversation for us to have. But first, I'd like to introduce our charitable sponsor, Jill Eaton from the Susan G. Komen Foundation. She is the executive director of the Inland Empire chapter, but she is going to be representing Southern California in our talk today. So Pete, why don't you, I'm going to share the screen, and why don't you take it away from here and we'll talk to Jill.
Hi, Jill. How are
Hi,
you doing
Pete.
today?
Hi, Pete.
Good to see you. Good to hear you. We're lucky because we're sponsored just by charitable organizations. We don't have any for-profit sponsors, and we encourage people to give to charity, because if we think it's good for the person as well as, of course, for the charity itself. Susan Komen. What is Susan Komen? What's special about Susan Komen? What's the mission of Susan Komen?
Wonderful. Well, Susan G. Komen is one of the largest breast cancer organizations that funds research and real-time help to those facing a breast cancer diagnosis. And I'm so fortunate to be one of the executive directors for this wonderful organization. I have the pleasure of working with many different families that are facing a breast cancer diagnosis. And thank you so much, Trevor and Pete, for allowing me here today. Our mission is to save lives by meeting the most critical needs here in our local communities, and also investing in breakthrough research. It is truly research that is going to help find cures and find an end to breast cancer. And so we're so grateful to be here.
How breast cancer, how prevalent is it?
Well, in the state of California, this year alone, there'll be more than 20,000 women that we will hear the words that they have breast cancer. So it's a very common cancer among women, and also men do get breast cancer. So it is prevalent.
Yeah, and do you, how of the monies that you receive, how much of that goes into research? So how do you spend the donors' money?
Wonderful. Well, we invest in research, and I can tell you a little bit about one of our focuses this year, which is metastatic breast cancer. And there has been more than $210 million committed to finding cures for metastatic breast cancer. And
what is metastatic breast cancer?
Sorry. Okay. Metastatic breast cancer is typically stage 4 of breast cancer, and it's when it has metastasized to more than one area beyond the breast. And so Komen is really committed to finding breakthrough research for that particular type of cancer. We want to see women live longer. We want to see more treatment to go towards that, so that we can help impact their lives and live longer. And so we're so grateful because Komen has invested more than $210 million towards this research in more than 500 research programs. And then there's also more than 50 clinical trials that are going on with regards to MBC. And I'm sure you've seen, like on the TV, there's been a lot of talk lately about metastatic. So that's one of the areas that we are focusing our funding area. Another area is the breast cancer treatment assistance program. And that is critical, because when you are faced with a breast cancer diagnosis, we want to make sure, Komen wants to make sure that that particular person is going to be able to get the treatment that was prescribed by their physician, and not have to really think about all of the financial obligations and the changes that could be going on in their lives. for example, if a woman or man needs to go ahead and quit their job, we want to be able to help them with their help them financially, be able to continue so that they do not have to pick between going to get treated versus going ahead and figuring out what is the top priorities in my life: rent, utilities, treatment assistance, medical, all of those medical needs. And so our financial assistance program is really critical and key. And we've seen it really used really a lot in the year 2020, sorry.
So if a woman or a man suspects that they might have a lump, or I guess that's the first clue as to whether or not you have breast cancer, can they call the Susan Komen line and say, this is what I suspect, and where do I go? Or do they go first to their medical doctor and go from there?
We would advise them to outreach to their medical professional and let them know what's going on, and you know your body best. So you will know the differences and changes that are taking place. And so we would highly recommend that you outreach to your medical physician or your medical provider and let them know. However, Komen also has a helpline and also has many different resources that you can go ahead and look up if you have questions with regards to if I feel something. We want people to be educated, and we provide a lot of documentation and a lot of resources here for education. We have a number 1-877-GO-KOMEN, and we also have a helpline at komen.org. And those resources are really available for anyone, including co-survivors or a caregiver or a family member or friend, because oftentimes it's the friend that's looking at the friend or the family member that is actually going online and looking and helping that person.
Yeah, I have a question.
Sure.
Someone came, so in regards to your research, this person is ethnically against animal experimentations, but she'd really like to support Susan Komen. Does your charity work with researchers to identify non-animal testing alternatives?
You know what, I will get back with you, but I know that we do many different types of research, and we have medical experts all over the United States. And we have Komen scholars that are very knowledgeable and very up to date, and also, want to make sure that we are doing the best that we can and finding the best ways to go ahead and help women make an impact on their life.
Okay. And I'm going to stretch, Trevor, I'm going to stretch your question out just a little bit, because I think this is really important. If you give to a charity, whatever the charity is, and I'm going to use the example when I was working at Long Beach State University, if somebody wanted to support a scholarship for the engineering department, but didn't want to support any other kind of scholarship, then they put that into their will or trust, and we honor that wish for the donor. So in this particular case, with that question, is that I wish to give to the Susan Komen Society for educational purposes in the community of Orange County or Riverside, and those monies will stay in that community or for that particular cause or activity that the donor wishes. Correct. Is that correct, Jill? Is that
100% correct? Donor intent. We always honor the intent of the donor and how they want to see their dollars raised.
Yeah, and so it's a gift, and so when you make a gift, you can make it the most meaningful for you. So some people want to just research, other people want to do it just for education. Some people want to do it for the hotline, whatever makes you feel good, because money is needed to do the job.
Yeah. Correct. So you can I put their Jill's contact information is up here. If you have follow-up questions, more specific questions, you can reach out to her, and she can definitely get the answers for you that you may be looking for.
Jill, I want to thank you so much for coming on and introducing us to Susan Komen. I hope you get a few calls and to inquire more. And I hope if you would like to stay and watch the session, you're more than welcome to, but there's no obligation.
Okay. Well, thank you so much, gentlemen, for your time. I appreciate it. And thank you again for your support.
You're welcome. Take care.
Take care. Bye.
Bye. All right. We're going to get into our presentation today with Michael Simon. Michael, why don't you bring up your Ask First form? And while he's bringing it up, I would say this particular session has had the most changes of any area of the law in the estate planning area. The other thing too is about this particular area of the law is there are very few attorneys who spend time on this particular area because it doesn't involve really the will, the durable power of attorney, the your living trust. There's no documents to complete because usually what you're doing is it's going to the financial institution and completing no documents on your own. And after this particular presentation that you're going to hear today, you're going to want to have it reviewed by legal counsel. So let me introduce Michael. Michael, you got a master's or other advanced degree, and I'm assuming that's your Juris Doctorate.
That is correct.
And where did you go to school?
Cal State Fullerton for my undergrad, and I went to Chapman Law School for my Juris Doctorate degree.
And how long have you been in the practice of law?
Well, I got my license in 2000, so we're just pushing 21 years.
And of those 21 years, how many years has that been in the estate planning area?
That has always been my focus.
So very rare, and that's what you want if you're going to see somebody in the estate planning area. That should be their only focus. There's so much to learn and become competent in that area, and it takes time. So 20 years is a good amount of time for you to learn your stuff. After 20 years, how do you get compensated?
Well, we charge for estate planning two ways. The first way is a flat fee or a standard pricing package, and other times we charge by the hour. For our standard estate planning, which includes a relatively straightforward estate plan, including a will, a trust, power of attorney, healthcare directive, we do all those documents. We also take care of doing a deed for you. But as we will learn later through this presentation, we also help you with your beneficiary designations for your retirement accounts and insurance. And so we try to pack a lot of value into our flat fee pricing. This pricing also includes all the attorney time, and we like to spend a lot of time with our clients to get to know them and make sure we're making a customized estate plan. So with all that said, our standard pricing for a straightforward estate plan is about, a married couple is about $3,100 to $3,400. And then for a single individual, it's about $2,200 to $2,500. Having said that, I have to make a caveat, and that is that if we do have complex situations with estate taxes and disinherited children and very complex situations, then we do charge more, and that is an hourly rate, and my hourly rate is $425 an hour.
And do you give any kind of a free consultation by phone or in person if somebody wants to check you out, so to speak, to see whether or not you are the individual to do their estate plan?
Absolutely. And so I'm always happy to do an introductory complimentary conversation. I can take a look at someone's trust, existing estate plan, or explain to them the process that we go through to get an estate plan put in place.
And then during the process of putting the estate plan together, do you charge for phone calls or emails as an additional charge?
Generally, the answer is no. So if someone completes their estate plan and then has a follow-up question, I'm happy to spend some time with them and answer those questions.
Okay, great. Okay, you don't team up with anybody to get referral fees, sell annuities or mutual funds or any kind of a financial product?
That's right. I do not.
Just for, it's a really a good question to ask, and I know Michael very well, and so that's why we both smile a little, because it's highly ethical and doesn't do that. But in the estate planning area, there's a lot of workshops out there, that's what those referrals happen continually. Another nice thing about Michael is that he has a financial background. He worked with Schwab for a number of years. And so he understands the financial services industry, which, by the way, most attorneys have no clue about money. They know about the law, but not about money. So Michael has that nice background knowing both. Let's get into the topic, because there are lots of changes going on.
Yeah, just before that, I just want to remind everybody, if you have questions, and this tends to be a lot of questions in this session, to use the Q&A thing, and I will try and get it, and I will pose the question to Michael if I feel it's good, or otherwise I will answer it myself.
Trevor, do you want to eliminate your screen on, I don't know if the participants can see your screen or not, but your screen is up on mine.
I think Michael's sharing it.
Okay.
Okay, and I was going to mention that I have tried to build in a little bit of time at the end of the presentation. So if there are some other questions at the end, hopefully we'll have time, and I'm happy to answer any individual questions with my email address is in the presentation material. So
yeah, we have over 50 participants already, Michael. So, and it's still climbing.
Well, fantastic. Well, I'm excited to be here and share some really important information with you. I'm always worried, Pete, no one's going to show up for this with such a boring title as retirement account planning. So kudos to everyone, and I'm happy you're here. This is a particularly timely presentation because, as Trevor mentioned, there's been a lot of changes in the last few years. I dare say seismic changes. Really, this is a whole different landscape dealing with these accounts. So you're in a good place to learn about this, and I think we're going to all come away with some additional information today. So with that said, let me tell you about what we're going to learn today. And as I just mentioned, we're going to be learning the latest rules that affect retirement accounts. And that includes discussing the Secure Act that happened in 2019, as well as the CARES Act that happened in 2020. And in fact, there were even some additional changes in 2021 with the recent stimulus package that was passed in March. So again, lots of changes. We're going to cover them all so you are up to date. Now, we're also going to talk about how we calculate required minimum distributions, sometimes referred to as RMDs. And if you don't know what an RMD is, then perfect, you're in the right place, because I'm going to explain it to you today. We're also going to talk about the options for choosing beneficiaries for your retirement accounts. And as Peter mentioned, this is a very important topic, as you'll see in just a few minutes. We're also going to talk about whether the stretch is dead. And again, if you don't know what the stretch is and if it's dead or alive, well, again, you're in the right place, because I'll cover it today. We're also going to talk about Roth accounts. They do have some separate rules, so we're going to leave them to the end, but I wanted to make sure everybody knew that we'll address Roth accounts also in my presentation. So with that said, we want to talk about a little bit of vocabulary through this presentation, and I'm going to be using the term retirement accounts. And when I use that term, I'm talking about your IRA accounts, your rollover IRAs, your SEP IRAs, your contributory IRAs, also 401ks and 403bs and pension plans and KIOs. Those are all retirement accounts as a generic term. So as I use that throughout the presentation, that's what I'm talking about and referring to. As you'll see at the end of the presentation, the Roth again has different rules. So when I'm using the retirement account term, I'm not referring to Roth, and I'll explain the differences at the end of the presentation. Now, why do we care about these retirement accounts? And again, your IRAs and 401ks, et cetera. Well, we care because when we make contributions to those accounts during our life, we get to reduce our taxable income. So really important. So if you make $50,000 and you put $5,000 into a contributory IRA account, well, guess what? We only have to pay tax on the $45,000. We get an immediate tax benefit, and that's great. One of the reasons and one of the important benefits of these accounts. Now, one new rule, and I'm going to build the Secure Act in as we go through the presentation, is that the prior rule said that we couldn't make contributions to IRA accounts if we were over the age of 70.5. And now they have removed that limitation, and you can continue to make contributions to your IRA account after the age of 70.5, but do keep in mind you do have to have earned income to make a contribution. Now, back to the benefits of the account, retirement accounts, and maybe the most important benefit is that the contributions, the money you get put into these accounts, get to grow tax deferred in these accounts, meaning that we don't have to pay current income tax and capital gains tax as this money grows. And this creates a really amazing compounding effect, and we are able to grow money faster in these type of accounts than taxable accounts. And so we have a significant amount of money that has been contributed and grown in these retirement accounts. And so Peter, I know you may know some of these answers, but anyone you want to take a guess on how much money as of December 2020 are in these retirement accounts?
Gosh, I bet you it's, yeah, no clue, Michael.
Okay, well, I'll give it to you. As of December 2020, there were 35 trillion, that's trillion dollars in these retirement accounts. That's up $17 trillion just from 2010. So there is a massive amount of money in these retirement accounts.
Wow.
What about Uncle Sam and all of this? I just told you there's $35 trillion sitting there, and it's all pre-tax money, meaning that it has not been taxed. Not only the contributions that everyone has made, but also the growth of this money has not been taxed. And so I asked rhetorically to everyone in this seminar, do you think the IRS wants a piece of this action? And of course, the answer is yes. And people are sometimes surprised to find out that the IRS still gets their tax even after you've passed away. And so what we'll find out throughout this presentation is that the IRS is generally going to get their share one way or the other. And in fact, as I just mentioned, the Secure Act, which is newly enacted, we'll talk about the details of this, but that Secure Act is expected to increase the IRS's share of the tax by about $16 billion over the next 10 years. So lots of money here for the IRS to tax. And this last point on this slide is maybe one of the most important points, is that this account, or these retirement accounts, again, your IRAs and 401ks are not tax-free accounts. They're only tax deferred. And as we'll see, generally the IRS is going to get their share one way or the other. They'll after you've deferred the tax.
Mikey, quick question. Someone asked about what about after-tax contributions to 401ks?
Well, so there are a couple of options for that. I'm not exactly sure the specifics of the question, but some retirement plans are now allowing you to make contributions to 401k plans, and they're sort of treated like Roth accounts. So they're already taxed money. And so that's a very interesting option to take advantage of.
Yeah.
Okay. Now, my last point before we get into the substantive material of my presentation is that this area is a really important part of estate planning. In fact, some of my clients' retirement accounts are their largest asset. I have clients who have IRAs that are more valuable than their home. But in the estate planning process, this area and retirement accounts are often overlooked. People get focused on doing their wills, their trusts, powers of attorney, and healthcare directives, and they forget about their retirement accounts. So one important takeaway from today is that if you have done your estate plan, make sure that your retirement accounts have been addressed. And if you're doing an estate plan in the future, make sure that this is part of it. I think it's a fifth pillar. So again, trust, will, power of attorney, and healthcare directive. And I think the fifth pillar of an estate plan is addressing retirement accounts and beneficiary designations. And we will be discussing that in detail today. All right. So the first part of my presentation is talking about the rules during life and how we treat these retirement accounts during life while the owners are still alive. So the first rule that I want to talk about is, unless there's an exception applies, withdrawals before the age of 59 and a half for these retirement accounts are subject to a 12.5% penalty. It's called an early withdrawal penalty. But keep in mind, this is in addition to normal income tax, because no income tax has been paid on these monies. So what I mean by that is that, let's say you take a distribution, you're going to have a 12.5% penalty, but you haven't paid income tax either. So maybe there's a 30 or 40% income tax on it, and we can get over 50% on these early withdrawals. So we need to watch out for that. Now, a couple of new rules regarding early withdrawals from retirement accounts is that in 2020, the CARES Act allowed us to withdraw up to $100,000 and not have to pay the penalty. You still have to pay the tax, income tax, but no penalty. Now, that doesn't apply to this year, and that's important. That has not been continued on, but last year we did have some relief. Having said that, there is a new part of the Consolidated Appropriation Act that passed in March of 2021. That was the stimulus when everyone got their checks in 2021. And there's a new exception to the early withdrawal called a qualified disaster distribution. It is not in, it is available, but what has to happen is a presidential declaration has to occur about a disaster in a particular area. And then if you fall into that area, then you can avoid the 12.5% penalty. So again, the real takeaway is if we took advantage of the CARES Act last year and took out a penalty-free distribution, that has not been continued for 2021. All right, Pete, I'm getting nervous. You haven't said anything in like 5 minutes.
Well, because you're doing such a great job, Michael.
All right, I'll keep rolling. Okay, rules during life, we'll continue with that. Now, after the age of 59 and a half, but before the age of 72, and that is not a typographical error, as I'll explain in a minute, it is not 7.5. So again, between 59 and a half and the age of 72, you are allowed to withdraw money from these retirement accounts, and there is no penalty. So that's great. It's an optional withdrawal, but again, no income tax has been paid. So if you take money out of there, again, no penalty, but you do get a 1099-R from your brokerage firm or your employer or the bank saying that you need to add this money to your tax return and pay taxes on it, okay? Now, this is where it starts to get a little bit interesting, and that is that starting at the age of 72, and again, not 70.5, the IRS requires you to start to withdraw or distribute money from these retirement accounts. Now, the new rule, as I've been referencing, changed the beginning date for our required minimum distributions. And previously, as many of you know, it was 70.5, always a confusing number. They've now changed it to age 72. So we do not need to start to make withdrawals from our retirement accounts until the year you turn age 72. Now, this is referred to as an RMD, this required minimum distribution. And again, there's no penalty because we're over 59 and a half, but as before, the tax, the income that comes out of those accounts gets recorded on your tax return via a 1099-R. And for us to understand this, and I will explain how the calculation works in a minute, but the concept behind all of this is the IRS is simply saying, we have let you have a tax break long enough. We have let you deferred all the way to the age of 72, and that's long enough. And now we are going to force you to remove a small amount of money every year after the age of 72 for one simple reason. So we can collect the taxes. By the forced withdrawal or the required withdrawal, then the IRS starts to get their share. Now, with limited exceptions, as I mentioned, this RMD or required minimum distribution starts in the year you turn age 72. And I just want to clarify one point is that last year, as many of you know who are doing required minimum distributions, the CARES Act provided for not taking your required minimum distribution. Everyone was basically excused for that. And I just want to point out that that was last year's rule that has not been continued. So in 2021, this year, we do need to do our RMD this year, okay, provided you're 72. Now, in most cases, this distribution has to occur before December 31st of each year, but there is a special rule we call the first year rule, and you can effectively delay your distribution into the following year all the way until April 1st in the year that we turn 72. But this is a tax trap, and I want people to watch out because what ends up happening is that, I'll give you an example, if you turn 72 this year and you have a distribution that's required and you decide to take advantage of this first year rule, you can delay your distribution all the way until April 1st of 2022. But that hasn't excused you from your 2022 distribution. And so in fact, you'll have two distributions in a single year. We call that bunching the income. And when we do that, it could push you into a higher tax bracket, again, because we have two distributions in the same year, cause higher taxation of Social Security, maybe increase Medicare premiums and things like that. So watch out for this. In most cases, although this is available for our first year rule, most of our clients don't end up taking advantage of it and prefer to take the distribution in the separate years to avoid the bunching of income. Now, a couple other things I want to mention about required minimum distributions is that you can always take more. So if you calculate your required minimum distribution, which I'll show you in just a second, and it comes out to be that you're required to take out $5,000 from your retirement account, and you decide to take 10, that's great, no problem. But the extra $5,000 doesn't give you any credit for the following year. Unfortunately, we have to redo the calculation like normal. And just to give you a sense about how serious the IRS is about you doing this correctly and making sure you take your distributions, there is a 50%, that is 50% penalty on the money that's left in these accounts that was supposed to be distributed by a RMD. So for example, if you were supposed to take out $10,000 according to the calculation, and you decide not to do it because you have some great investment in your retirement account, there's a 50% penalty. So the numbers don't really work. We do have to do this. Even with a great investment, you can't really clear 50% penalty.
Michael,
Oh.
I got it, Trev.
Okay.
I'm 72, Michael, and I'm still working. Does the fact that I'm still working mean that I don't have to take my minimum distribution?
Well, it depends. So there are some rules for 401ks where we can delay the distributions.
But generally, the answer is no, that you need to take the distributions. Are you going to discuss at all whether or not you should roll over your 401k to an individual IRA or to keep your 401k until the end of your life?
Well, why don't we address that right now, since it's on, you've mentioned it. And so the question often comes up when we're retiring and you have a 401k plan at your employer, whether it is a better idea to leave it at the employer or perhaps exercise your right to roll that over into an individual retirement account. We call it a rollover IRA account. And there are a couple of caveats which I'll mention, but the generally it is preferable to roll it out of the employer plan for a couple of reasons. The first reason is that we can get into a larger universe of investments and opportunities to invest that money. Oftentimes the 401k plans have a limited area. Maybe you can only invest in one mutual fund company, something like that. So we like the flexibility to roll out of an employer plan into a IRA for more flexibility in that area. The second reason we do it is that many times the employer plans have limitations on what they will allow you to do and what your beneficiaries will do. And the IRS gives us the broadest possibilities, but the plans can limit those possibilities. And we find that there's very little flexibility in employer plans. So having said that, a lot of people like to roll out of the plans. Here's the one caveat, is that employer plans are covered by a special federal law that gives more creditor protection. And so we do want to make sure that before we move it out of an employer plan, that we look at the issues of asset protection and things like that before we make a final decision.
Yeah, and just remember that because they're an employer plan, they're more leaning towards the benefits to the employer than they are to the employee. And so your average 401k plan in the United States has an annual cost of approximately 3%. So it's much more expensive in most 401k plans versus you putting a rollover IRA together with a Schwab or Fidelity or with a Vanguard. When we talk about general rules and generally, the hardest part about doing a workshop like this is not to take what we say generally and apply it to yourself and say, this is the rule for me. We don't know your situation. So every single employer 401k plan is a little different, and you need some expert advice either from a CPA or from an attorney or from your financial advisor to see what's best for you.
You can also probably get some information from the plan administrator if it, regarding that specific situation.
Correct.
Yeah.
Okay, well, we are ready to talk about how we actually calculate your required minimum distribution. And the first point is that there's good news that most banks, brokerage firms, etc., will send you a letter in the year you turn age 72, and they will show you and tell you what they believe to be the calculation for you. So in some respects, that's a convenience, and everyone is required to do it. So you will get a letter at age 72 for each of your accounts. Now, it is important for you to be able to check their letter, but also there can be other reasons why you want to do the calculation yourself. Now, we do have to do this calculation every single year, as you will see in just a second, but let me show you this required minimum distribution, and it's relatively simple. All we do, as we can see in this first box, is take the December 31st balance of the prior year. We divide that by a divisor or a life expectancy factor, which I'll show you how we get that in just a second. And we divide these two numbers together and we get our required minimum distribution for the year. Now, this is part of a uniform table that the IRS provides. And this uniform table, we'll talk in a little bit more detail in a minute, and I have a larger version of this. But for purposes of this illustration, most of us use the uniform table. I'll go into the exceptions in just a second. But what the IRS tells us for 2021 is that if you're 72 years old, your factor or life expectancy divisor is 25.6. So I'm going to use a hypothetical that I have a $100,000 balance on December 31st of last year. I'm age 72 in 2021, so I got my factor off the IRS uniform table, that's 25.6, and I divide those two numbers together, and the IRS is telling us that we need to distribute $3,906.25 to meet our required minimum distribution. And again, the idea here is that you now need to record that on your tax return, and the IRS is going to start collecting their share.
So is the 25.6 kind of like the IRS saying that is your expected life expectancy?
That's exactly right. In fact, here's a larger version of the table, and as you can see, it goes all the way. It goes farther than this, but my example takes us to 99. So if you make the 99, you still have 6.7 years left.
I love that.
So what I've done with this table, though, is I've added this column here, which I'm calling a withdrawal rate percentage column. And I think it's really interesting to look at this because what I've done is I've converted these to percentages. So at age 72, the IRS is saying that you've got a 25.6 years left life expectancy. And using that factor, they are only asking you to withdraw 3.91%. This is a very relatively generous number. In fact, I'll just jump up to age 80 here. If we go to 80, the factor converts to 5.35%. That's a pretty small amount. In fact, in prior versions of this table, the percentage was much greater. So for an 80-year-old, we might have a good year in the market. We might make more than 5.35%. So I have clients who, even after withdrawal, have more in their retirement accounts, even after they've taken the required minimum distribution. So these are pretty generous numbers. Now, this life expectancy divisor comes off this uniform table. And although I have put it in my presentation, it is also available in the IRS publication 590B, which is hot off the presses with all of this information. And in there are all the different tables. Most of us, if you'll see in the first or the sub point under this life expectancy divisor, the uniform table is used for almost everyone. The most common exception is that if you have a spouse or beneficiary named on the retirement account that's 10 years younger, then we do use a different table. But for everyone else, we use this uniform table. And to make it a little confusing for everyone, the IRS has proposed a new table. So the one that I am showing you is not going to be effective next year. It's going to be, there will be a new table. And again, you'll have to get a new 590B once they publish it. It'll be effective 1/1/22. So let me clarify this. So the tables that you're looking at that are in the 590B currently and in my presentation are good for 2021, but they're going to give us a new table for starting in 2022. Now, the good news is the new table, although it's not a big change, it's even more generous, something like 1/4 or 1/2% less. So it's even more generous than before. So you'll need to start using that new table next year. And again,
Michael, will institutions figure out your required minimum distributions?
that's right. And so in the year you turn 72, that institution should send you a letter and do the calculation for you. Now, one additional rule that is worth talking about is applies only to IRA accounts. But if you have more than one IRA, you can calculate the required minimum distribution separately for each of these accounts, and then cumulatively add that together and take it out of one single IRA account. So a common example might be that you have an IRA at the bank that's got a bunch of cash in it, and then you got an IRA at, I don't know, Fidelity that's fully invested in stocks and bonds, and you don't want to sell the stocks and bonds to do your required minimum distribution. So again, you can calculate these separately, add them together, take it out of the bank IRA that has cash, the cumulative amount, and it will cover the required minimum distributions for both accounts. So a handy rule to use, but again, it doesn't work for 401ks and 403bs, only for IRA accounts.
So a person can have a spousal rollover, they can have an inherited IRA, they could have a rollover IRA. Yeah. So somebody can have, not of their own doing, can have multiple different IRAs.
Yes, and you mentioned an inherited IRA. We'll talk about that a little bit later, but that has a different calculation. The one calculation we're talking about is when it is your account and you are the owner.
And let's say if you have a rollover IRA and you say, hey, I've got 6 grandchildren and I want to leave them each a portion of my IRA. Can a person create an individual IRA account for naming one grandchild for each of those IRAs?
And the short answer is yes, and we've got a slide for that.
All right.
Yeah, we'll be handling the inheritance, like the rules after death, a little later. There's Michael, there was a quick question regarding RMDs, and the question is, can the accumulative amount of the RMD be IRA and SEP totaled together, like a SEP IRA and another, maybe a traditional IRA?
Is the question, can you do the calculations for the, does this rule apply to SEP IRAs and IRAs, and could you add it together? I'm not sure that I know the answer to that. I think the answer is yes, but I am not positive, and I hate to say this, but we'd have to check with the CPA to double check the rule there. It's been a long time since I've looked at it, or you're welcome to email me and I'll look.
Yeah, I'm married to a CPA, and I have a SEP IRA and a regular IRA, and yes, you can.
Okay, great. So then to clarify then, so if this person had a SEP IRA and a regular IRA and they wanted to calculate them separately and then take it out of one of those two accounts cumulatively, that would be permissible.
Yes.
Thank you.
Okay, the last part about rules during life is a really interesting rule called the Qualified Charitable Distribution Rule. And what the Qualified Charitable Distribution Rule says is that if a taxpayer wants to distribute money from their IRA and gift it directly to a charity, they can exclude the income from their tax return. And you'll see in a minute why this is important. Now, the Qualified Charitable Distribution law has had sort of a torrid history of being temporary and then it ending and then making retroactive, and it's gone back and forth. And a number of years ago, they finally made this law permanent to the extent that any tax law is permanent, but it is part of the code now, and we can continue to use it and not worry about its expiration. Now, as you'll see in just a minute, more consideration to using this special rule it should be given under the current tax law, and I'll explain that in just a minute. So to best understand the qualified charitable distribution rules or law here is that you have to understand the way that it worked before the rule. And the way that it worked is that if someone wanted to take money out of their IRA account and out of their IRA account and give it to a charity, they would take that money out, they would put it in their bank account, they would write a check to the charity, but they would have to include that income on their tax return in something we call AGI, or adjusted gross income. And then the hope was that you would get a charitable deduction to offset the income that you had to record on your tax return. But unfortunately, it didn't always work out that way, particularly for clients who didn't itemize their deductions, because when you don't itemize, you don't get a separate charitable deduction. And what's important about this is that under the new law, as many of you know, they have moved what we call the standard deduction, where we're not itemizing, to a much higher level. And so many of us are taking the standard deduction and not itemizing. So without this rule, what would happen is you'd have to record the income on your tax return, but you wouldn't get a corresponding deduction. The other problem is that when we added this money to our adjusted gross income, or again on our tax return, it also affected things like Social Security benefits and the taxation, Medicare premiums. It would also affect deductions of things that are related to your income on your tax return. So it didn't work out very well. So come to the rescue, the qualified charitable distribution rule. And what ends up happening here is that the rule says that if you have the money sent directly to a charity, that the distribution gets excluded from your income again. And so all of the problems that I just described don't exist. But interesting enough, the distribution still counts for your required minimum distribution. So let's think about that for just a second. You want to make a donation at the end of this year to the Komen Foundation, for example, and you're going to write a check for $2,000 out of your checking account. Why not think about doing it through your IRA account, right? We can take money out of here. It will not be recorded as income on your tax return, or more specifically, it will be excluded as income on your tax return. And it counts towards your RMD to either satisfy it or partially satisfy it. It's a very, very good result. I see you shaking your head, Pete.
And it's very easy to do. I just turned 72 and this year and last year, and we made all of our charitable contributions from the IRA, and all of us should, if you're 72 and over and you want to make a charitable distribution. It's better than apple pie.
Okay. Well, let me tell you a little bit about the rules for charitable, these qualified charitable distributions. The first is that you can do as little as you want, but only or to a maximum of $100,000 per year. To use this rule, you have to be 70 and a half or older, and that isn't a typographical error. I think maybe it may have been an oversight when they made the new legislation. They left this one at 70 and a half, so you can start this at 70 and a half, not 72. Distributions must be made directly to the charity. And one thing we need to watch out for, and this is a little bit confusing, but the Secure Act, if you decide to use to make contributions to your IRA account after 70 and a half using the new rule, that they will make you use those contributions up before you can use this qualified charitable distribution rule. And I know that's confusing. So here's the takeaway, is that if you're going to make deductible contributions to your retirement account after 70 and a half, let's talk to your CPA first before you do it, because it will limit your use of this special rule.
And the qualified charitable check that you receive has to be made out directly payable to the charity. It can't be made payable to you as the individual. Now, you can't ask the brokerage firm, whether it's Schwab, Fidelity, whomever, to mail you the charitable check, and you can forward that charitable check to the charity. And because what happens a lot of times is the brokerage firm will send a check to the charity, but it will not include your name in a memo line or on the check. So they don't know, the charity doesn't know where that check came from. So I just want to be aware of that. Some brokerage firms will put the names on, some don't. Just be aware of the situation.
Right. And so we've had that situation where, again, we'll use the Komen Foundation. They just get a check $1,000 from Charles Schwab. They have no idea where it came from. So sometimes we have our clients call the charity ahead of time to let them know that the institution would be sending the check.
Yeah, and we also get a very common question is that do we get an additional charitable deduction of making a gift this way from our IRA account?
I love the idea, but no.
And the reason
So
for that,
because it's excluded from your income, you also do not get a charitable deduction.
yeah, you haven't paid taxes on that amount to begin with.
Okay.
By the way, if you had to compare the two, this is a much better deal not to have it included in your income versus the charitable deduction. 60% of people over 65 do not itemize. And so their charitable deductions were useless to them. So this is a really a nice gift that the Congress has given us.
Okay, well, the next part of my presentation is about how these accounts are treated after you have passed away. So it's about choosing beneficiaries and the rules after death. And I see Peter appropriately taking a sip of his coffee. And if the participants have an espresso machine, this would be the time for us to get a shot of espresso. They make this, the IRS, a complicated area. I'll do my best to make it as simple as possible. And in fact, I've come up with these 5 concepts that we'll go over first before we start talking about the rules. And I think if you understand these concepts, that you will better understand the rules as we go through them. So the first concept is that during your life, you get to pick the beneficiaries for your retirement accounts by filling out something called a Beneficiary Designation form. Now, the good news about this is that it is what we call a contract to pay on death, or a TOD, meaning that there's no probate. So you get the form from your bank, your brokerage firm, your employer, and you fill it out. And if it's filled out properly, then we don't have to have your retirement accounts go through probate. The second point under this first concept is that you can change these anytime you want to. And there were some rules prior to 2002 where there were limited amount of times you could change it and who you could change it to. Those have been eliminated. So the latest dated one that is on file with the institution that has your retirement account is the one that counts. And this third subpoint under this first concept is maybe one of the most important points of today's presentation. And that is that these beneficiary designation forms that you fill out control what happens to these accounts, not your will and not your trust. And so we have a lot of confusion in this area. If you have a will and trust and you're leaving everything to your sister and your brother, and then you fill out a beneficiary designation form saying, I leave it to my neighbor, the beneficiary designation form is what supersedes your will and trust. So these are very powerful, important forms, and that's why we're going to spend some time talking about them in just a minute. Now, the second concept is that after you have passed away, the person that you've named on this beneficiary form, a designated beneficiary, can continue to defer the income until the money is withdrawn. Now, we're going to talk about that in a minute. But the third concept is that the IRS still wants their share, and they require the beneficiary that's named to withdraw the money from the account. So again, the IRS can get their share. The fourth concept is that from a tax standpoint, it is preferred in most cases that a beneficiary avoid taking all the money out in a lump sum distribution 2 weeks after you've passed away, because number one, they lose all the potential of deferring some of the income tax that may be due into later years and allow the money to grow tax deferred. But they will also likely pay the highest tax because the lump sum distribution will bunch all the income into a single year. Now, when we talk about, we're going to talk about this in detail in a few minutes too, particularly as it relates to children. But the fifth concept is that generally the strategy is to try to make your beneficiary keep the withdrawal period as long as possible. Now, before the Secure Act, we could do something we called stretching, because the law provided that if we named a child, we could use that child's own life expectancy to calculate how long they could defer the tax on this money inside of a retirement account. But the Secure Act changed all that and unfortunately kind of put a lid on this stretching. So this is a little more detail about the Secure Act. And what the Secure Act basically did was say that we are going to eliminate the ability to stretch these retirement accounts for potentially decades for anyone who has passed away after December 31st, 2019. And basically the Secure Act provides that in most cases that a beneficiary, including Roth beneficiaries, will have 10 years to withdraw the money from these retirement accounts, not their own life expectancy, but 10 years. This is a little bit complicated. The general rule is 10 years, but there are some exceptions. We call them, or the IRS is calling them EDBs, eligible designated beneficiaries, a special class of beneficiaries that are not subject to this 10-year rule. And those are surviving spouses, a minor child of a taxpayer, disabled or chronically ill individuals, and individuals who are not more than 10 years younger than you. Those are our exceptions. Everybody else, adult children, etc., who are named as beneficiary, they will have a 10-year window to withdraw the money.
We're going to have a test after the session is over to see.
Yeah, I told you they really made it complicated.
Yes.
Now, we'll talk about how the Secure Act works in just a second. But as we look at choosing beneficiaries, and the reason we're going through all this is that the rules and the options for the distribution of these accounts after you've passed away is all contingent on how you fill out these beneficiary designation forms. So the selection of the beneficiaries for these forms is important. And that's what we're going to talk about now, is who should we put on these forms? And I have come up with 5 beneficiary designation options, or let's call them classes. We can name spouses, we can name children, grandchildren, or other adults. We might be able to name trusts, charities, or maybe some combination of all the other classes. So I'm going to go through each one of these individually. The first option for taxpayers who have retirement accounts that are married is to potentially name the spouse as the beneficiary. Now, the benefit of naming a spouse is that the money does become immediately available to that spouse. There is no 10-year limitation under the Secure Act. And so that's important to make clear. We don't have to worry about this between spouses. The Secure Act didn't hinder retirement accounts left between spouses. And in fact, what continues on is a special rule we call the spousal rollover rule, or the spousal rollover option. And let me explain how that works, because most clients take advantage of this. And the way it works is that you have an IRA account and you've named your spouse as a beneficiary and you've passed away. Your spouse has the option to open up a new IRA account and move your IRA account into his or her IRA account. And that spouse is treated as if they own the account from the beginning. That means they can name new beneficiaries, younger beneficiaries. If they're not 72, they don't have to start the required distributions, because again, it's treated as their own account. And in fact, spouses, according to a Supreme Court decision a number of years ago, even get some extra creditor protection because it was a spousal rollover. So a lot of people take advantage of this spousal rollover rule. Now, the disadvantages of the spousal rollover rule is that the spouse does have full control of the money. And this may not be the best issue or the best solution if we have blended families, et cetera, because the spouse can either move the money, spend the money, or name other beneficiaries. And so in those circumstances, we might look at a different option. The second option is naming children, grandchildren, or other adult beneficiaries as our beneficiary for our retirement accounts. Now, it is true that minor children are exempted from this 10-year rule until they reach age majority. And do keep in mind that as soon as they become the age of majority, then they are subject to the 10-year rule. And by the way, we still don't know what age of majority is. The IRS hasn't quite determined that. It might be 18, it might be 21. Some commentators even said age of majority might be 25. But in any case, we don't want to name minor beneficiaries as outright beneficiaries of any retirement account. I'll address that in detail in just a minute. So the idea of naming an individual grandchild or minor beneficiary is really a non-starter, as you'll see in just a minute. But as far as adult children and grandchildren, well, again, they have up to 10 years to distribute the retirement accounts if we name those beneficiaries. And so this does have potentially many years, really up to a decade of deferred growth and avoiding the income tax. So there's some options there. 10 years isn't nothing, so that's worth it. And also some of our clients who are in this situation are hoping that their children will manage the tax brackets. And what I mean by that is that during that 10-year period, maybe there'll be periods where a child who has inherited a retirement account has low income for the year. We take some extra money out that year and try to manage the tax brackets over that 10-year period. Now, what are the disadvantages of naming a child, adult child, grandchild as a beneficiary? Well, if the child is named as an outright beneficiary, again, as we don't want to do it at minor children, but we have to watch out for our children not doing a lump sum distribution and paying the highest taxes. Some children have spending problems. We call it creative spending, or they might have creditor problems. So we need to think this through before naming a child. I know this is a favorite topic of yours, Peter.
Yeah, it's one is that you have the Gifts to Minors Act, and so no child under the age of 18, I believe here in California, can own assets. Is that correct?
That's right. So that's one of the reasons we don't want to have a minor child, and I'll jump ahead a little bit, and named or minor grandchild, is that they don't have a legal signature until age 18. So if we name a minor child, we've got a real problem. We likely have to go to court and start something called a guardianship just to get things going, a very expensive, complex, and cumbersome procedure.
Yeah. And so in what Michael is alluding to is that in my fiduciary practice and in a CPA practice, we deal with many, many, many families, and maybe 5% of the families that we have been dealing with stretched out the IRA account. Even CPAs who know better, people seem to, once someone dies, the IRA account is the first account that's accessible to the beneficiaries, because all you need is a death cert, a copy of the beneficiary designation form, and a driver's license. And so, that kitchen for the last 10 years needed to be remodeled. And so that IRA account goes to a kitchen remodel, or to a new car, or to a new vacation. So, and what people don't understand is that the tax implications of this, and we'll talk about that in just a little bit more.
Now, we can name a trust. This is our third class of beneficiaries as a beneficiary for these accounts. The trust must meet certain IRS requirements and include some special language, but the advantages of naming a trust are potentially that it provides this control to avoid irresponsible spending and things like that. It also can protect assets from creditors and so forth. And if it's done properly, it can take advantage of the Secure Act exceptions, those for surviving spouses and minor children, chronically ill and disabled individuals, and individuals not more than 10 years younger. So there is some possibility to use a trust. There are disadvantages from using a trust. One is that if we're married and we name a trust instead of a spouse, we can't do a rollover. Also, the trusts, particularly after secure, need to be drafted very carefully to make sure we're taking advantage of the new laws. And if you had an existing designation that involved using your trust after secure, it's worth having that looked at and make sure your trust has the right information and provisions in it. One of the problems that people don't like about trusts is that if the money that we receive from an IRA account stays inside the trust, it pays a higher tax rate. And not necessarily a higher tax rate. It gets to the higher tax rate much quicker. In fact, it's about $13,000 worth of income, and then you're at the 37% tax bracket. So we can pay higher taxes by using a trust. They're also administratively complex and expensive, but if they're necessary, they're necessary. One of the national commentators in this area that a lot of us follow is named Natalie Choate. She says, look, there's some drawbacks here, so you better have a compelling reason to use a trust. But if you have a compelling reason, then we'll have to deal with some of these disadvantages. Now, the fourth option is naming a charity as a beneficiary. Now, this is a very interesting topic because all through this morning, I've been saying that the IRS is going to get their share. Well, here's the way we beat the IRS, and that is by leaving part of our, either all or part of our retirement accounts to charity, because they don't pay income taxes. And in fact, if we have a large enough estate, we can even get a estate tax deduction. So this is a real benefit by naming a charity and doing your charitable gifting through an IRA account when you pass away. But what we find is that a lot of clients tend to do the reverse of this. And what they end up doing is they give their assets that have not been taxed to their children, so they suffer the income taxes, and we give our assets, for example, out of trusts to charity that have already been taxed. And we want to swap that because it's a better result for everybody if we do charitable gifting from retirement accounts and we give the already taxed money to children that might be in a trust. Now, the fifth option is sort of what Pete mentioned earlier, and that is that we don't have to make one choice. So we can have a large IRA that has a spouse as a beneficiary, a child, a trust, and a charity. Or as Peter suggested, we have clients who sometimes divide a larger IRA account into separate IRA accounts and name individual beneficiaries. So lots of flexibility here. And that's why it's important, again, that we spend time thinking about what's going to be the best result for naming beneficiaries for the retirement account.
Again, if you're going to do more than one IRA account or do what as you get older, you want to stay in control of your money. And the more complex you make it, the likelihood is you're going to lose control later on because you got to keep track of all the different pieces. So the general rule ought to be is, what is the simplest way I can design my estate to accomplish my purpose? Don't get into the complexity of this because you feel that unless it really benefits you or the children.
Okay. Now, one slide to wrap up this or nearly wrap up this section is how do we respond to the new Secure Act and the ability now or I should say lack of ability to stretch the retirement account. We have clients whose life focus was to try to make this the stretch last as long as possible for their children. So in responding to the Secure Act, one, I have clients who are simply accepting the new situation. I mean, we've got 10 years, we'll make the best of it. As I mentioned, manage the tax bracket. So that's one way we could respond. Another option that people are looking at is possibly looking at naming a charitable remainder trust or other charitable strategy to try to stretch out the payments over a lifetime. So that's a possibility. I have clients who are looking at possibly buying what we call wealth replacement insurance, and insurance that would in essence help pay the income tax on the retirement accounts. We can do something we call Roth conversions, which we'll talk at the end of the presentation about, but that's a strategy that people are using to potentially address this new 10-year rule. Of course, as I just mentioned, we can avoid all of this by leaving it to a charity, right? That takes the income tax aspect out of it. And of course, you can always spend it. And I know that sounds funny, but it's not really a joke. We have, and Peter for sure has had clients spend their lifetime trying to preserve their retirement account. And, 7 days after you've passed away, the whole thing gets pulled out, taxes are paid, and we remodel the kitchen. So we can always spend it. That's always a good strategy.
It's a new concept.
Okay. Now, this is also a really important slide. I'm briefly or quickly go through it. These are the mistakes we've seen come to our practice that we've had to help correct. So look at this slide, make a note of it. I don't want anyone who's watching this presentation to make these same mistakes. So here are some mistakes. The first is not naming a beneficiary, i.e. not filling out a beneficiary designation. It happens all the time. If it's blank, we go to probate court in most cases, so that's a real mess. The same result happens for point 2. If you write in my estate, and I think it's done with the best intentions, people think maybe that means my next of kin, my closest living relative, in essence means we've got to go to court to figure out who is your beneficiary and open up a probate. So don't write in my estate. We've already covered, don't name minor children or grandchildren. It's going to be a mess. The fourth point is not naming both primary and contingent beneficiaries on these beneficiary designation forms. So when you look at these forms, you have an option to name first beneficiaries, in essence, second or contingent beneficiaries. And we want to name both. Unfortunately, life doesn't always work out as planned, so we do want a backup plan, but we can also do something we call post-mortem estate planning. And maybe there's a reason our primary beneficiary doesn't need or want the money, and maybe we want to take steps to get it down to our secondary or contingent beneficiaries. So there's lots of planning that can be done even after you're gone, but we can't do that unless we filled out the form with both primary and contingent.
Yeah, Michael, we just had a case that where the primary beneficiary died and she did not name a contingent beneficiary.
Yeah.
And so what's happening now is that we have, for that amount that's less than
166,250.
It's a little less than 166,000. However, she also had a bank account that was that puts her over 166,000, and now we're having to go through probate here in Orange County with COVID and the court system backed up. A large portion of this person's estate is now probably going to be held off to distribute for another 2 years and an extra $20,000 in costs because they didn't put in a contingent beneficiary.
Yes. Okay. I'm on the fifth point is not keeping beneficiary designations up to date. On more than one occasion, I've met a new client who has their spouse from 2 marriages ago named as the beneficiary at their employer for their retirement account or their IRA. So we want to make sure as the family's situation changes that we update our beneficiary designations. And I know this is a point that Pete often makes, and that's the second to last point about not keeping records of your beneficiary designations. What has happened with a lot of these bank mergers and brokerage firm mergers is that they've lost the designations. So we always encourage our clients and help our clients get confirmation that their designation is on file. We don't want a he said, she said after you're gone and us trying to prove that they should have a designation on file when they say they don't.
Will they? Okay, hang on a second. Yeah. Will they accept, if you made a photocopy of your beneficiary designation form, is that final proof for the institution to say that this is the correct beneficiary designation?
No. So what each institution will do almost automatically is when you submit it, they will generate a letter saying we now have this on file, and that's the one that you need.
Yeah. So what I was getting at is there was a question earlier. A lot of times now, like with Schwab and these custodians, you fill this out online, don't you? You don't do it when you're like the people will, when you can change it online, you can do all that. And there was a question about whether, you know, should we print it out? Should we do this?
Yeah.
But it sounds
my
like
recommendation
every time you change it, they send you something.
Yeah. My recommendation is not to use the online services. Now, when you fill it out, that should generate the letter, but we prefer and we ask our clients to get the physical forms because the only reason they're doing it online is it's easier for them, right? And so the first response from employers and brokerages is they say, you know, you can do that online, and then you say, I know, I still want the form. And the truth is most of us have customizations enough that the form doesn't work very well and we need to do an attachment and they can't do what they want online. So the bottom line is we prefer forms.
Yeah, and when you get the copy back from the institution, put that form with your estate planning documents so that you can kind of take a look at it 10 years from now or 15 years from now and see exactly who you named. Because people die, people move, people have problems. And if you don't have a record, your mind is not going to remember as to whom you've named.
Yes, and for those of us who might have already have their designations on file and don't have a confirmation, you can simply call the institution that's holding that account and ask for a confirmation letter. They will generate it for you.
And by the way, your next point is probably the biggest mistake, and the most often is that income taxes are never ever considered. Well, most times are never considered in selecting whether it's a charity or what, some kind of a tool, or the beneficiary designation, because somebody who is already in the 50% income tax bracket, let's say combined California and federal, and somebody who's unemployed, their gift is going to be completely different after taxes.
That's right. Okay, the last part of my presentation is about Roth IRAs, and then we'll open it up to questions if there are any at the end with the last few minutes that we have. So the Roth IRAs do have a different set of rules. So for example, my first point is that Roth IRAs do not have required minimum distributions during your lifetime. So all that stuff I talked about how you calculate your RMDs and the tables don't apply. Roth IRAs don't have RMDs while you're alive.
I am shocked that the Secure Act did not change many rules on the Roth IRA.
Yes, well, we've talked about that, Pete, that this is a gift, this area, and we would have expected, and we've always expected some legislation to shut it down, but it was not. So no RMDs. You can continue to make contributions as long as you have earned income. So there's no age limitation on it. The money in here, and this is really what you're referring to, Pete, grows tax-free. And that's not a typographical error. You don't pay tax on the growth of this money inside the Roth IRA accounts, which means that there are tax-free distributions to you and your beneficiaries later in life. Now,
plus 10 years.
Right. Now, the Secure Act did limit the time that a beneficiary can continue to quote unquote stretch the Roth IRA after the owner's passed away. They have the 10-year cap on it too. So that same rule applies, but we can do spousal rollovers. And if you have a big Roth IRA and you name your spouse, we can just roll that IRA over into a spousal rollover IRA. That's also a Roth. So lots of flexibility. So many of us will say, well, I don't want my old retirement account. I want to get one of these Roth IRA accounts. And there is an opportunity to do that, but it requires careful consideration. So we call this Roth conversions, and you can convert a traditional IRA or other retirement account into a Roth IRA account. Now, everybody is eligible to do this. There used to be some income limitations. You had to make less than a certain amount, but they've done away with those. So anyone can do the conversion. But the third point is key here is that you got to pay the income tax on the conversion. So we need to do careful analysis to see if this makes sense. And there's no more what we call recharacterization. Prior to 2018, you could do this conversion, and if you didn't like the results, you could take it back. Well, now that rule doesn't apply anymore. Once you pull the trigger on this Roth conversion, there's no going back. You're stuck with the results. And now, what are the factors that we would look at to do a Roth conversion? Now, the first factor is that you would consider is that if you know your income tax rate is going to be higher in retirement, well, maybe it makes sense to do some Roth conversions at your lower rate currently. So that's a factor to think about. Another factor is that you don't think you're going to need the money for living expenses and have to withdraw it, because remember, we want the money to stay in the Roth account to try to make up for all the tax that we had to pay on the conversion. And that dovetails into the next point, is that your investment time horizon has to be long enough to benefit from this tax-free growth so that we make this all worthwhile. And that's why we have to do a lot of calculations to make sure it makes sense. But the second to last point is the most important point, is that you've got to be able to pay the tax from separate funds. And so here's what I mean is, let's say you're going to do a $100,000 Roth conversion, and I don't know, the tax comes out to be $40,000 that you've got to owe. We don't want $60,000 netting into your Roth IRA. We want the full 100 to get into the Roth IRA, and for you to use maybe your brokerage account or your checking account to pay these taxes so that we can get that larger amount into the account. If we get the net amount, the numbers never work. It just doesn't calculate. So we need to watch out for that. We also want to make sure that we're looking at estate planning objectives, which can be also taken or addressed during one of these Roth conversions. So with that said, the last thing I want to mention is that you can do some interesting planning and maybe jumpstart your child's or grandchildren's retirement fund using one of these Roth accounts. 100% of the child's earnings up to $6,000 this year can go into that account. And it doesn't actually have to be that child's earnings. So let's say the child or grandchild works at Togo's making sandwiches and they make $6,000 and they spend it. You can use your own $6,000 and contribute it to a Roth IRA for that child or grandchild, as long as they had the earned income. And that means at the age of 59 and a half, all the money, all the growth for all those years, they get tax-free withdrawals. It can be a bundle of money. Before the age of 59 and a half, they can still withdraw the money without penalty regarding the contributions that were actually made. There are special breaks to withdraw the money early for college and first-time home purchases, but don't forget, the child after the age of 18 or grandchild will be in control of these accounts. So we need to watch out for that, because our best laid plans to create this amazing retirement fund for a child or grandchild could be spoiled on a brand new car at age 18 if we're not careful. Do you want to add anything to this, Pete?
Yeah, it's just my son is 32 years old, and the company that he works for does not have a 401k plan. So we had set up a Roth IRA account for him when he was 10 years old, and he would go over to grandma's and wash the windows, wash her car, mow the lawn. And since she was a tax preparer as well, she paid him $50 an hour of earned income. Now, $45 of that $50 an hour went into his Roth IRA. And today, he still has that Roth. He still contributes to that Roth IRA, because at his present income, he doesn't get that much of an income tax deduction contributing to a regular IRA account. So it's a great tool to use, and it has gotten him to learn how to save.
So to wrap it up, there are many parts or components to an estate plan. Today, we focused on the retirement account aspect of it, and I hope that you got a lot of information so that retirement account fits in with the rest of your estate plan to make one successful estate plan. And with that, we still have a few minutes, and so we can play free-for-all on the attorney and ask any questions that you guys might have.
Okay, Trevor, why don't you go ahead and start with some of the questions that we got online?
There was a comment saying you cannot do a Roth conversion with your RMD. But most of the questions, let's see. One of the things I wanted you to clarify, Michael, was a lot of people they name their trust as their beneficiary in their beneficiary designation form, probably with the understanding, or they think that it's just going to distribute just like their trust. But what are some of the, let's say I have to distribute a $1.3 million in IRA, and I have the oldest beneficiary is 85. She was the life companion, and the youngest is 18, and there's 7 in between. Whose rate of distribution? I know there's only a 10-year limit, but whose rate do we use? Do I use the 18-year-olds to distribute, or would I use the 85-year-old?
Well, Trevor, it depends on when the owner of the account died. And this is we could do another hour on this, but under the old rules, if again, we died before the Secure Act was put in place, we would unfortunately have to use the oldest living beneficiary as our measuring life for distribution for everybody. So that was a real problem with using trusts. Under the new Secure Act, everyone is generally entitled to 10, but that's not even always the case. If the trust isn't drafted properly and it is not considered a designated beneficiary, you might even be dropped to 5 for everybody. So careful consideration has to be looked at regarding the trust. And that's why I suggest that people look at their trust. If they're naming a trust as a beneficiary under Secure, it needs some special provisions in it.
How are withdrawals handled differently if you contribute after-tax dollars to your IRA or 401k?
So if I understand the question correctly, if you make non-deductible contributions to a retirement account, yes, they are handled differently. And in fact, when you make withdrawals, the IRS has a special form you fill out so that the non-deductible part doesn't get subject to income tax because it's a return of money that has already been taxed.
Yeah, but it gets complicated. This entire, if you have questions, then you're normal. Okay. You just, the complexity is there. And so if you have a large IRA account, please get professional help. It's not intuitive. So you need to spend a little bit of money to get expert advice to see how to accomplish your purposes as to what you want to do. And I know your puzzle at the end is a little bit of a marketing ploy, but it really is true. It has, the IRA account has to fit in with the rest of your plans. And they're not just separate entities that you can just plan on it yourself without combining. And the fact that you had mentioned, Michael, that you see a lot of charities included in estate plans, wills, and trust, and then excluded from the retirement plans, and yet that should be completely reversed.
Yes. And also the way we handle the beneficiary designations at our firm is that we actually make an attachment. It's a template. So once we've decided what the strategy is going to be, we try to make it easy on our clients by creating this template. And then on the blank form, we don't try to fill out the form because they have all kinds of special rules and things like that. And we stamp on the form "See attached," and then we have exactly the way that it's supposed to work. So we have consistency among our retirement accounts. And if you change jobs or roll over, you just go to your binder and pull out your template and attach it. You don't have to worry about remembering the way it was supposed to be.
Yeah. Michael, there's a question. How does the IRS track your IRA distributions? I think she's referring to maybe the 1099 process, how that works.
Well, let me answer that in 2 ways. One is that once you take the distribution out, a 1099 is issued. So you do the calculation and you're supposed to take out $3,000. When you take the $3,000 out, you get a 1099-R. If the question is, how does the IRS know if that's the right number? They don't. And so this is, I don't want to say it's on the honor system, but it isn't really a gray area because you take the December 31st balance, and if you decide to shortcut it and you get caught, it's a 50% penalty.
Yeah, and the penalty kind of keeps everybody in line.
Yes.
But you know, what happens when somebody has Alzheimer's or suffers from some sort of dementia or has a stroke and they can't manage themselves? Who has power now over the IRA account?
Right. And this is really important because we want to have a complete estate plan, which is going to include a power of attorney, because this unfortunately comes up quite frequently. Someone over the age of 72 now has dementia, unable to do their required minimum distribution. And unless we have a power of attorney, that money is going to be subject to the 50% penalty. So our power of attorney then can come in, operate the account, do our minimum distribution, and quite frankly, save the day.
So it's really important that people complete the durable power of attorney form. And should they give that form to the institution prior to death?
Well, that's an interesting question. I'll make this fast. I know we're crunched on time. Oftentimes, it is preferable to use the institution's own form during life. There can be reasons for this, convenience-wise, and maybe spouses want to be on each other's accounts to place trades. And if we have incapacity happen, provided that that form provides for durability, meaning it lasts during incapacity, then that's an easy way to do it during life. Now, you can also submit as an alternative during life our attorney drafted durable power of attorney, and it gets approved by the legal department of each institution and added on there. So when I have perhaps impending incapacity that we know, maybe early stages Alzheimer, what we usually do is get the powers of attorney on everything now before we have an issue where the person doesn't have a valid signature.
You spoke so fast on that. You are perfect at 11:29.
No, that's
this is such a complicated area, and
yeah.
Michael, you just did a great job.
And don't forget, everybody, that this is going to be recorded and posted on our website, and you can go back. The first half of the presentation, rules during lifetime. The second, rules during death, and it's pretty, you can kind of find what you're looking for based on that.
But don't forget about incapacity. When you're dead and gone, you're not going to worry about this stuff. Okay. But incapacity, you're going to be alive, and somebody has to manage that IRA, that 401k, and and if you haven't talked to them about it, they're going to be up to their own device as to how they're going to do it.
And it's not going to be your trustee unless your trustee is your power of attorney. So that's something people have to understand.
Yeah. Because it's very rare where your trust is the appropriate beneficiary of your IRA.
Yeah. So, well, Michael, that was as always, just so thorough and obviously very well presented. Next week, we are going to be going into selecting your fiduciaries. So who are going to be these people wielding these documents on your behalf? And we're kind of going to go into a deep dive of the duties of the trustee, the executor. We'll touch a little bit on the agent for power of attorney, but for the most part, it's a very practical presentation, and it's sort of at the angle of a family member serving, because most of you will have family members serving in these positions, and we're going to kind of expose a lot of the pitfalls that a lot of family members get themselves into when serving in these fiduciary positions. So, sorry, I was going to ask you to tell about next week, Pete, but I just did.
You did a very good job, because I want people to believe that we're going to help family members be a fiduciary. So this is not about trying to get you to a private professional or get you to a trust company. This is about having a family member understand the liabilities and the rules involved. And there are a lot of them. And as probably Michael knows, most of the litigation comes about because of family issues. So that's where we're going to go.
All right. Okay. Well, thank you, everyone. Have a great weekend. We'll see you next week.
Thank you.
Take care, Michael.
Bye-bye.